throw this up there. All right. I think this is the slide that we ended up on in this class last time. The other class got a little bit further. It won't hurt them to see this again, but essentially what I've done is I've summarized everything we just did. Remember, there were two different systems. We were either using the periodic system. Just as a reminder, periodic means that we do the inventory count at the end of each period. And we also did the perpetual system, which meant that we did an inventory count every single time there was a transaction. And so you get slight differences between those two systems depending on the assumption. And so just to kind of highlight here, we had increasing prices. And so as prices go up, if we look at LIFO, you can see that LIFO had the highest cost of goods sold of the three cost flow assumptions, and it had the lowest ending inventory. FIFO had the lowest cost of goods sold and the highest inventory. And so anytime you have price increases, it's going to look that way, and then average cost is going to be somewhere in between. And the reason why, if we kind of, oops, it didn't like me there. There we go. Is because LIFO carries current costs, the latest costs on the income statement, while FIFO carries those current costs on the balance sheet. And so if costs are going up, under LIFO, the highest costs are going to be on the income statement, whereas under FIFO, the highest costs are going to be on the balance sheet. The other thing that we talked a little bit about last time, but I just want to re-highlight here, is that between the two systems, average cost and LIFO, they have different numbers because of the timing element. But again, under FIFO, you get the same numbers regardless of whether you use periodic or perpetual. Again, kind of visualizing a bucket where we're draining from the bottom, whether we drain as we're going along or whether we drain at the end, doesn't matter. We're still draining those oldest ones, where under the other assumptions, the mixture changed. And so that's why we had different costs depending on whether it was periodic or perpetual. And again, just as a reminder, IFRS does not allow LIFO. We're going to talk about on the next slide why that is. But LIFO was basically something that was added under US GAAP because of actually a tax treatment. And so we'll talk about that. But IFRS, they obviously don't care about the US tax code. And so IFRS does not include LIFO as an inventory cost flow assumption. Uh, I think it kind of makes sense why. We talked about it last time that, if you have these layers that keep getting added, remember we're scooping off the top. And so you have a bucket, you put a bunch of things in the bucket, you got layer after layer after layer. And if you never kind of scoop far enough down, you might have layers that are years or years and years and years old. And quite honestly, that's just not realistic. And so IFRS basically said that's not realistic, so we're not allowing that as a cost flow assumption. And so what are the things that might determine whether you use average cost, FIFO, LIFO, whatever it is? A big one, honestly, is physical flow. We kind of used the dairy example in class. We also kind of talked a little bit about like grocery stores and whether it be restaurants, things where there's spoilage. Very common to sort of say, okay, well, let's let our inventory cost flow assumption reflect the actual flow of our goods. And so that a lot of times FIFO is going to be the one that most closely resembles the actual flow of goods. And so if you're trying to just follow that physical flow, many times, not every time, but many times you're going to use that FIFO cost flow assumption. The one that we touched on a little bit, and this is why companies might use LIFO a little more, is because you might do it for tax purposes. And so the IRS does allow LIFO, which allows you to put your most current costs on the income statement, which then reduces your taxable income. And if you have lower taxes, most companies prefer that because that gives them more cash. But what the IRS did is they said, okay, well, listen, we will allow you to use LIFO or whatever cost flow assumption you want, but you have to be consistent between what you file with us as the IRS and what you report to the SEC. And so companies kind of report slightly less net income because of the tax benefit, in times where prices are going up. And so that's kind of a major reason that companies might use LIFO. And I forget the percentage, but more companies use LIFO than the other assumptions. Tax treatment is the reason why. A couple of things with the conformity rule, and something we got to kind of think about multinational companies, because there's kind of two things going on. So
I'm
under
sorry to
LIFO,
bother. Do you
obviously
care
there's
if
a
I
there's
jump
potential
in?
tax benefit. Um, and then at the same time, though, multinational companies have to think about transfer pricing because I can use cost flow assumptions to shift income from one tax jurisdiction to a different tax jurisdiction. So you kind of have two things going on. There's the ability to reduce taxes, but there's also the ability to shift income in between tax jurisdictions. And the whole goal would be then to minimize your taxes. And so again, whenever you're making those choices, the idea is you're trying to minimize your taxes. And so you may use FIFO if it allows you to shift income to a lower tax jurisdiction, even though in the US, it might have been advantageous to use LIFO if it allows you to shift income to, let's say, like Ireland, where the tax rate's like, I don't know, a third of what it is in the US. You might choose that. And so, again, tax treatment can be a reason you make these choices when it comes to your cost flow assumptions.
Professor Martin, I have a
Yeah,
question.
yeah.
In our notes, it says that only 24% of companies use LIFO while 47% use FIFO. So if
Oh,
we were to get tested on this, should we say that LIFO is the most common?
no, it's not. I always thought it was. I must not have. I just didn't update my own mind. So yeah. So really, I'm surprised. Again, I sometimes I pull data from what was like way back when, because it used to be kind of like I think 60% used to, but it's really shifted away from that. It's very interesting. But no, I don't. That question isn't on the test, so that makes it easy. But if it were, and I would have to count both because I said both.
Okay, thank you so much for clarifying.
Yeah, thank you for clarifying that as well. All right. So again, if you're not worried about taxes, but you're trying to focus on net income, in that case, you might prefer FIFO because obviously that in general is going to overall increase your income if you have increasing prices. But again, you again may want to use a system to shift profits. Maybe you're not minimizing taxes, maybe you're maximizing profits because you want a certain segment or a certain geographical area to demonstrate the highest income. And there's very interesting studies out there. If you have like a multi-segment firm, and if the market prices your company, a lot of times they assign different multiples to each segment. In other words, they kind of aggregate it and say, well, let's say I don't know, like you have a manufacturing arm and you have a software arm and you have some other arm and all under the same company. Well, like software, usually profits in software segments get a higher multiple in the market than like manufacturing. And so if there's a transaction between those two segments, may want to maximize the profit in your software segment and minimize compared to your manufacturing because overall your stock price would be probably higher if you reported it that way. And so there can be some choices when it comes to cost flow assumptions, also just to maximize your net income. All right, LIFO reserves. So LIFO reserves is something where basically what you end up with is, okay, internally, I want to use FIFO, average cost, whatever, for internal purposes. And I list some reasons here because, first of all, maybe it's cumbersome to track with LIFO because you got to keep track of all these different layers. Maybe you have a contract with a supplier or a government entity or something where they're like, hey, you have to use FIFO. Or you may be making internal decisions or pricing decisions based on your kind of actual costs internally, and you want to make good decisions. And so you want to use something that's more accurate, like FIFO tends to be. But you may want to still use LIFO for the tax benefit. And so you've got an issue where you've got like this internal process where you're using FIFO. but externally you want to report using LIFO because of the tax advantages or for whatever reason. And so how do you reconcile the fact that my inventory system is going to use FIFO, but I want to externally report using LIFO? And what we do is we have this thing called the LIFO reserve account. It is a contra asset. In other words, you can imagine we have inventory using FIFO sort of sitting here in this bubble. And then we have this LIFO reserve account that kind of gets, sort of attached to it so that for external purposes, we have like a net inventory account. Our core inventory account doesn't get touched, but we have this additional account that basically adjusts the inventory so that in total, in net, we have a LIFO inventory amount that's being reported externally, even though internally we're using FIFO. Now, I want to stop there in case we're not sure what we mean by that. I just want to be very, very clear. Does everyone kind of get the idea?
No, I'd appreciate if you went over that just a little bit further.
Yeah, sure. So the idea here is that, again, internally we're using FIFO, and so when we're doing that, we basically, maybe to say it another way, our most current costs are going to be tracked internally in our inventory account. That's what we're going to do. But for whatever reason, we want the tax advantage or whatever, we want the other advantages of LIFO for external purposes. And so essentially what we have then is we create this additional account so that we don't touch our inventory account. We're still going to use that internally. But now we're going to create this contra asset account that basically adjusts the inventory so that it looks like LIFO when we report it externally. Now, one thing we want to highlight here that I didn't quite say the first time is that under FIFO, we already mentioned that your inventory costs are generally going to be higher than what they would be under LIFO. So FIFO is going to have higher inventory. And so what we do then is we use that contra account to kind of adjust the inventory account so that we have like net inventory that's slightly smaller when we report externally. And so then essentially there's two sides of this. You make an adjustment to the inventory, net inventory using this LIFO reserve account. And then we've got to sort of do something on the other side of that. And the other side of that is we make an adjustment to cost of goods sold, which is really the benefit we're after, is we want to take that inventory cost and move it into cost of goods sold, which then allows us to basically overall report lower taxable income. Not every single period, but generally speaking, that's what's going to happen. Did that help, Jason?
Yeah, no, that did. I got all that. I appreciate it.
No worries. All right. So again, an example is probably going to help. And also just to be clear on the test, you're not going to have to like do a long workout problem with this, but you do need to understand sort of what's happening and at least understand, okay, did my LIFO reserve account go up? Did my LIFO reserve account go down? If it went up, is that a debit or a credit? And if it went down, is that a debit or a credit? So it's not going to be a long workout problem, but there is a question on the test. All right. So in this
Question.
example, yeah.
This would never work the other way, right? Where it would be like they record it as LIFO and then they want to adjust it so it's FIFO for the net
Right.
income.
So this only goes from FIFO internally to LIFO externally. Correct. All right. All right. So in this example, again, the idea here is I use FIFO internally. When I do that, using FIFO, I have three different months of balances, 11,300 in January, 12,200 in February, and 12,000 in March. We're just going to have COGS set at 85,000 to keep it simple. Starting at the beginning of the year, they had a reserve account balance of $100. And as a reminder, it is a contra asset account. Since it's a contra asset account, this $100 balance is a credit balance. It's a credit balance. And again, the idea here is internally, I'm using FIFO. Externally, I want to use LIFO. We're going to just do this on a monthly basis. And so when they actually look at the accounting method, if they had used LIFO, they would have reported 10,800 in January, 12,000 in February, and 11,600 in March. And I want to be very, very clear here, though. Whenever they do this calculation, they are not going to touch their actual inventory account. They're just saying if we had used LIFO, This is what we would have reported in our inventory, but we don't want to do that. We want to report our actual inventory account using FIFO. And so now we're going to use this LIFO reserve account to make an adjustment, to reconcile or sort of make it look like LIFO externally, right? So then we got to go through and do this adjusting entry for each of the 3 months. And I'm going to kind of do the first one together, and then I'll pause and give you a few minutes or whatever for you to work on the second one yourselves. I'm not going to give you a ton of time, but just we'll pause.
Throughout doing this problem, would it be smart to T account the LIFO reserve or no?
It depends. Most students at this point aren't huge T account fans. If you are a huge T account fan, there's nothing wrong with using it. But I would just say, generally speaking, it wouldn't be needed.
Okay, thank you.
Yep. All right, so if we think about our beginning balance was $100, and now we're looking at the end of January. And we have to say, okay, what was the LIFO reserve account balance at that point in time? And so if we had reported, or sorry, when we report, if we go back, we reported FIFO internally at 11,300. Externally, we would have reported 10,800. And so that internal amount minus the external LIFO amount tells us that the balance should be $500. Now, again, this is a debit balance. This $500 is a credit balance. And if we put them together, that means externally, we would report a net of $10,800. Now, again, the inventory account would still be 11,300, and it would just be combined with this contra asset of $500 for a net $10,800 sort of net inventory balance. Now that's the balance. That's not necessarily the journal entry. To get the journal entry, we have to look at the change compared to the prior balance. And so the balance or the change is the new balance of $500 minus the old balance of $100. So now we're going to increase the contra asset account by 400, which means we need to credit that account $400. So we would credit the LIFO reserve account. Notice it is a contra asset, so it's in the 100s. We're going to credit that account $400, and then that is going to be offset by a debit to cost of goods sold. So what we've now done is our inventory account is still FIFO. But when we net it with the contra inventory account, that LIFO reserve account, externally, the net inventory is going to be LIFO. And then with this adjustment to cost of goods sold, our final cost of goods sold is also going to be LIFO. Does everyone kind of follow that? All right. So let's try the next one on your own. So I want you to do February. So the February balance, again, we're taking the FIFO amount, we're subtracting the LIFO amount, and that gives us the balance. So I'm going to give you like a minute or so to go ahead and get the journal entry. So we're after the journal entry for the month of February.
T accounts help me, so I'm gonna go back to this real quick. So when we do that 500 and when we're doing this 200, that is our ending balance of the reserve account.
Yes, we are
Okay.
calculating the balance. Yes.
Okay, perfect. Thank you.
Yep. I'll give another 30 seconds or so. It shouldn't take too long. All right, see how we did. So again, we have that balance. We have to compare it to the prior balance of $500. Now notice the LIFO reserve account is actually getting smaller. Since it's a contra asset, we're going to reduce that account with a debit entry. So we debit the contra asset $300. It's offset by a credit to cost of goods sold. And then finally, for the month of March, we again calculate that balance. Again, the FIFO inventory balance is 12,000. The what would have been the LIFO inventory balance is 11,600, which means the balance in our LIFO reserve account should be $400. Of course, that's the balance, that's not the entry. To get the entry, I have to compare it to the prior balance that we just calculated of $200, which means I need to credit my LIFO reserve $200. So my credit to my LIFO reserve 200, offset by a debit to cost of goods sold, also $200. All right. Hopefully everyone's got that. Sorry, give me 1 second. 1 second. I have a sliding door to my office that my one dog busted open. Didn't want him to start barking or anything like that. All right. All right. So let's now move on to thinking about that cost of goods sold number. So again, the whole idea here is we want our external reporting to reflect LIFO. And so we have our inventory account under FIFO. We have a balance that we calculated that's sort of that contra asset that gives us now on our balance sheet a LIFO amount of inventory for external reporting. And then cost of goods sold. With the adjusting entry now, the FIFO COGS was 85,000 internally. But now we make an adjustment so that cost of goods sold is updated to be a LIFO amount when we produce those external financial reports. And we would do the same thing in February, of course. In that case, the adjustment was a credit to cost of goods sold, so it reduced it. And then March, again, it was an increase of $200, which would increase it. All right, so that's what we report every single period externally. So these amounts is what we would report, and that is a LIFO measure of cost of goods sold. Again, the key here is I want to use FIFO internally, and so that's what's kind of prompting this exercise. Okay. LIFO liquidation. Um, a little bit of again, I think it's similar as far as the way I'm going to test it. I know that it's similar to LIFO reserve where there's not going to be a long workout problem, but just the concept of what's going on is something that you need to understand. And so what I'm going to kind of walk through, we're going to do some calculations just so that you can see it, but I'm not going to go into a lengthy problem on the test. So we're just going to kind of move quickly through this. And then the online lecture that talks about this, I could probably go a little slower than I'm going to go today. And you can review that if you really want to get into the nitty-gritty. But the whole point of the idea of a LIFO approach is when we had that bucket, right? And we kept adding layers, right? And every year we would add layers. Sometimes you might dig into a little bit, but you just keep adding these layers. And you could have a bucket, we kind of said theoretically, where you might have costs that are years or even decades old, sort of by assumption. Even though we know the inventory itself is long gone, but what we've got is we've got costs that might be decades old or for sure years old. And so the issue is, what happens as those layers build and build and build? We sort of operate as usual, but you could have a situation where all of a sudden in any given period where maybe my sales in terms of units outpace my purchases. And again, that whole bucket, all of a sudden, instead of just taking off a little bit, let's say we dig way down, right? We're liquidating a lot of our inventory. Again, this is like no kidding, real units. But the issue is I could have been carrying some of those units at very old costs. Now, again, this is just an accounting exercise. It doesn't mean that I have old units. It just means that I have old unit costs. And all of a sudden, if that happens, you have what's called a LIFO liquidation, where all of a sudden you're recording some of your sales or some of the costs associated with your sales at very old costs. And so what happens when you have a situation like that, where all of a sudden, instead of current costs as part of cost of goods sold, I have costs from 10 years ago that are part of cost of goods sold. And so what would happen? Well, first of all, your gross profit is going to shoot way up. And with the increase in gross profit, your operating expenses haven't changed. Therefore, your net income is also going to shoot way up. And so you could have a financial statement where all of a sudden you look way more profitable than you were in previous years. And it's not due to the fact that you're more profitable. It's actually just due to the fact that you're liquidating some of your old inventory at old inventory costs. And so it can be very, very misleading. And so just understand this is a side effect. When, again, it would be very, very clear. It happens when your sales outpace your purchases. As long as your purchases outpace or are similar to your sales, you're not digging into those old layers. But as soon as that doesn't happen, all of a sudden that's where you're going to dig into those old layers. Does the concept at a high level make sense to everybody? Hopefully the visual got there. Okay. Again, stop me if something doesn't make sense. And so this table, again, we're just going to kind of walk through this. I'm not going to animate it or anything crazy. But essentially what we've got is we start with some inventory. And then in 2024, you can see that we purchased 12,000 and we sold 11,800, which means we're going to add a layer. And in 2025, we purchased 13,000, we sold 12,700, we're adding another layer. And then 2026 is meant to illustrate when you have a LIFO liquidation. We only purchased 10,000 units, but we sold 13,200 units, which means we liquidated a lot of our inventory. And again, just to be, as I do go slower in the other version of this that's already posted, but we're going to kind of move quickly just to kind of show this to you. Hopefully it doesn't lose you too much. But essentially, in 2024, our cost of goods sold, everything's coming from that 2024 layer. Again, because we bought more than we sold. And so our cost of goods sold is 165, which gives us a gross profit margin of around 24.3%. And then we got another layer, right? So we've got the 3,000 units, and now we've got a few units from 2024. And then in 2025, again, we're taking everything out of that 2025 layer because we bought more than we sold. When we do that calculation, we get a gross profit margin of 25%. Again, nothing really going on here, but now, of course, we've got three layers. We've got the layer at $10 a unit, $14 a unit, and another layer at $15 a unit. Again, this is just sort of building layers. You can imagine this going on for a decade potentially, right? And then all of a sudden in 2026 is a little bit different, right? Because now we only purchased 10,000, but we sold 13,200. And so now when we pull, we sort of assume the units that are being sold, we're selling all of these, and we're selling all of the units outside the 2025 layer. There were 300 of them. All of the units left in the 2024 layer, there were 200 of them, and a pretty good amount of the original layer of 3,000 in total, 2,700. So the idea here is instead of everything being at $15.50 per unit as far as our cost of goods sold, now we have some of these old costs and including a very old cost of $10 per unit. And so when that happens, our cost of goods sold is 189,300, and our gross profit shoots up to 31.71%. Now this is compared to like 25% as far as what we had before. And so you might not think that's a huge deal, but the reality is if you're a company and you go from 25% gross margin to almost 32% gross margin, I'm telling you, that is a market mover. Everyone would wonder what in the heck is going on there? What are they doing so well? Or they're going to start to question what's going on. And in this case, hopefully we would be able to conclude, oh, it's a LIFO liquidation. They didn't really become more profitable. They just did on paper. And so again, this is where understanding the way inventory cost flow assumptions kind of create these situations is really important for you as an accountant or a finance person or providing advice to people. It's really important that you understand why that might work. And again, you're not going to do a calculation on the test, but you should understand what LIFO liquidation can do.
So I have a stupid question regarding that. So when you say we're not going to have like a comprehensive or whatever example of
Yeah.
this, well, we should be able to answer whatever question you have using the information provided in this packet.
Absolutely. Yeah. I mean,
Okay.
it'd be a very straightforward, like, I don't know exactly what I asked, but it could be true or false. When there's a LIFO liquidation, gross profit margins uh, typically are much larger than in previous years. That would be true, right? Or if I said they're much lower, that would be false. So that would be, again, I don't remember exactly how I asked it, but that would be a fair question.
Okay, thank you.
Yeah. And so then, of course, after all this is said and done, we're only left with 300 units at that at that original $10 per unit cost. All right. Now, here is where, if you're going to struggle in chapter 8, this is the topic, dollar value LIFO. Um, I'll admit, I think I've taught this topic like 3 times, and I had to teach myself probably 2 or 3 times before I taught it the first time, because it's not an easy topic to grab onto. I think that the way I teach it is going to make it much more digestible. But I'm going to tell you right initially, I had to really grind on this topic to kind of say, okay, what is it exactly that we are doing? And maybe for other professors, it came to them a lot easier than it did to me. But I'm just going to tell you, like, I had to grind on this topic to really get it to pop and make sense to me. And so feel free to stop me and ask questions, because if it's not making sense to you, you're not alone. It didn't make sense to me the first time, but I really tried hard to make it very logical and sort of let you go on the path that I went down for this to make sense for me. Now, the whole idea here is that what we had been doing is we were tracking specific units and specific unit costs. We did things very simple in that we said, okay, one layer at a time, sort of 1 year at a time. So we had constant units and one cost for an entire year, right? And we were assuming that we could somewhat track that. Okay. You could imagine a situation where you might have a company where tracking exactly every single unit and every single cost of every single unit forever would be very, very cumbersome and very, very difficult to do. And so when you don't want to, or you aren't able to track specific unit counts and specific unit costs, then you might use basically like this estimation process, for lack of a better phrase. You're going to, instead of tracking specifically, you're going to do estimates to kind of infer or estimate what's going on with your inventory rather than being very, very specific. And so the way that you do that is what are called by using what are called LIFO inventory pools. And so again, it's taking, that should say inventory. Basically, what you're doing is you're aggregating things into like a larger pool. So you're not tracking specific inventory items and specific inventory costs. You're just not doing it. And you're grouping them together to kind of simplify your accounting. Like dollar value LIFO basically takes that idea of grouping things and broadens its application. And I can't say that I've worked a lot with inventory from an accounting side, like in practice. But some of the other professors and practitioners I've talked to say a lot of companies use dollar value LIFO because it simplifies things, but it is an estimate. So I want to be very, very clear. We are estimating our inventory rather than doing specific counts and specific unit costs. And so it's a different approach, but it is an approach that is I don't want to say widely used, but it is regularly used. Now, as I mentioned, for some students, this is a very, very difficult thing to understand. And so if you're struggling a little bit, don't interrupt me. Let me help you. But hopefully, I'm able to kind of walk you through it. Now, the way that you group things, the idea here is you're really looking at microeconomic price pressure rather than physical similarity. So you're looking at things that are priced similarly and where their prices go up or go down together, sort of very similarly. And it's just allowing you to kind of apply this method to a larger group of inventory rather than applying it to specific units. And so it's just, again, it's an estimation approach. We're not tracking individual units and individual unit costs. Instead, we're using aggregate information to kind of infer what we should report. Does that make sense? All right, I'm going to assume so. All right. All right. So dollar value LIFO. So a key feature whenever using dollar value LIFO is this idea of developing cost indexes. And essentially what it's doing is it's just measuring price inflation for a group of inventory. Now we're just going to use one common group of inventory, but understand a company could have several different groups with several different separate cost indexes that it's all tracking independently. We're keeping it simple and we're just doing one group, but knowing that the same methodology could be used for several different groups at the same time. They'd each have their own cost indices, and we'd go from there. But again, we're just developing a cost index is critical here. And again, what we're trying to do when we use these cost indexes, we're not tracking individual units and we're not tracking individual unit costs, but we do want to understand when we see changes in our inventory, are those changes attributable to volume or are they attributable to costs? Remember, we're not tracking individual layers anymore. So we really don't know exactly how many layers are going into our inventory. All we know is we had X inventory. Now we have X plus inventory. Well, did that increase? Is that because the cost of our inventory went up? Or is it because the number of units in our inventory went up? Which one is it? And so the idea here is we need to try to disentangle those two things. When I'm tracking individual units and individual costs, I absolutely can see it. But when we are aggregating and we're estimating, it's not apparent because we're not tracking it at the individual level. So we need a method that allows us to make the distinction between volume and cost. All right. So again, when we're doing this, we're not focused on units anymore. Instead, we're focused on the overall value of the inventory. And again, this will make sense when we start to get into the example. And so the first step whenever we do this is you have to develop an index. And so whenever we have an index, again, we're grouping things and we're grouping our inventory together in different groups. We're still thinking about layers. Now, those layers then are going to be based on value, not units. And so those layers, then we need to create an index for each layer. Typically, it's going to be by year. We're going to make it by year to keep it simple. You could do it differently, but we're going to do it by year. And so what you have is at any given time, you can estimate the value of your inventory, usually at that current layer cost. So like in 2024, I would figure out the value of my inventory in 2024. In 2025, I'd reevaluate that inventory in 2025. But you're going to look at it at what is the current value of my inventory. And over time, even if I had the same physical inventory, the value is going to go up because costs generally go up. But also you could also be adding more inventory itself. So we don't know exactly what's going on, but what we want to do is basically on a dollar or a unit per unit to unit basis, has the cost gone up or not? And so you're going to look at what is the cost in terms of that layer year, like 2024 costs, 2025 costs, whatever it is, and you're going to compare it to some sort of base year. Every company has to choose a base year. Usually it's the first year where they implement dollar value LIFO. And whatever that base year is, you're going to compare current costs to that base year costs. That's what you're going to do. So for every single layer, you're going to calculate a cost index. Now, obviously, we're going to give you, or I'm going to give you layers sort of boom, here's a bunch of different layers. In practice, of course, you would be adding a layer 1 year at a time. So you wouldn't have every single year immediately. You're in 2024, you'd add the 2024 layer. In 2025, you'd add the 2025 layer. So you'd go through time. Obviously, for a problem though, I'm going to have to give you all that information simultaneously. And so how do we interpret a cost index? Basically, the base year, by definition, the index for the base year is going to be 1 because the base year, the cost in the base year over the cost in the base year must be 1. At any time when you add a layer, again, whenever you add a layer, it's meaning you're purchasing more than you're selling. Anytime a layer is added, you will have a new cost index. And so if costs have gone up, then the index will be more than 1. If costs have gone down, then the index will be less than 1, of course, because this ratio is going to be more than 1 or less than 1. Now, 99% of the time, the index is going to be more than 1 because almost always the current value, the current cost of your inventory is more than some base year, and that base year might be 10 years ago. Now, is it possible that you could have something less than 1? Absolutely possible, but not typical. And so in this class and on the test, the indices are only going to be above 1. I'm not going to make an index that's less than 1. I don't want to complicate your life the first time seeing this. All right. So once we get the idea of what a cost index is, we're going to walk into an example. All right. So here's our example. So they had these inventory balances. And so what do we have is we have sort of at the very beginning of 2024, again, this cost index, so this is creating that base year. The value of my inventory as of January 1st, 2024 was $120,000. We're choosing that as the base year. So the index related to that is 1. Then we come to the end of 2024. At that date, the value, I want to be very, very clear, the value of my inventory was $132,000, but that value is based on prices or costs as of December 31st, 2024. And so what happened? Well, we can see by this cost index that the cost of my inventory went up. We don't know yet whether the number of units or the volume went up. We don't know that yet. We know for sure the cost went up. It's unclear whether the volume also went up. It's possible that both happened. It's possible that the cost went up and the volume went down. It's possible that the cost went up and the volume stayed the same. All those could be the case. We don't know yet. But remember, under LIFO, we don't report inventory at end of year costs. We report inventory at the acquisition cost. And so while everything here is listed at the acquisition cost, on December 31st, it's not at the acquisition cost, it's at the cost at the end of the year. And so we got to make sure we disentangle, right? We have to disentangle what were the new units that were, what's the new volume that was added, and what was the cost when we added those units. All right, we'll kind of walk through it and it'll hopefully make a little more sense. But again, same thing in 2025. We measure the inventory as of December 31st, 2025. That's the value as of that date. We know that the increase in the value relative to the base year is both because costs went up, but it also could be because volume went up. We don't know yet whether we added a layer. Same thing in 26, same thing in 27. So with each of these, costs went up every single year. Volume may or may not have gone up. Now remember, just to be clear, we only add a layer if volume goes up. We do not add a layer if only cost went up. And again, hopefully this will make a little more sense as we work our way through it. But that's what this chart means. This is the end of year or the current value of that inventory. This is the index, which tells you basically how much costs went up relative to the base year.
So you
Okay.
said we only make a new layer if the value goes up?
If no, not if the volume goes up.
Oh, volume, thank you.
Yep.
I have to try and distinguish this between periodic and perpetual at all, are we?
No, we are not. Any other questions? All right, good. All right, so there's going to be a three-step process. Now on the test, you're gonna have to walk through all three steps. So just you got to understand what you're doing with every single step. And so again, the goal here is to take our inventory in every single one of these years and figure out what would we report under dollar value LIFO. That's the whole point. What are we going to report for our ending inventory using dollar value LIFO? We would not report the year-end costs. That is not how we report under LIFO. We report them at their acquisition costs. And so we're going to walk through how we get there. The first step is you have to convert all of these end year costs to the base year costs. You have to convert them. Now, the reason why we're going to convert them is by what that does is that pulls out changes in cost and isolates changes in volume. And the whole idea here is that a dollar in 2024 is not the same thing, or well, December 31st, 2024 is not the same thing as a dollar on December or January 1st, 2024. We can see that through the cost index. And then similarly, the dollar in 2025 is not the same. A dollar in 2026 is not the same. And a dollar in 2027 is not the same. So for me to understand, did I add a layer? Was there an increase in volume? The first thing I've got to do is I've got to pull out, I've got to negate, I've got to sort of adjust for changes in cost. And the way that we do that is we take the ending inventory as of that year for that year, and we divide it by the cost by the cost index. And so what we're doing is we're restating the inventory at year-end cost and instead restating it in terms of base year costs. So this $122,222, that's my December 31st, 2024 inventory at base year costs. So we went from year-end cost to base year costs. But I want to be clear, we're not reporting our ending inventory at base year costs. We're reporting it at acquisition costs, which is why this is step one, not step three, right? So
Can can you
yeah,
re-say what the 122,000 is? Like, what is that number?
this is the 2024 ending inventory at base year cost. So
Thank you.
yep. All right. So that's step one. Restate everything in base year costs. And again, the whole idea here is we're trying to eliminate the influence of inflation and instead focus on volume. That's the whole point. And so we do the same thing in 2025, 2026, and 2027. So now every single one of these years, we take the year-end cost and we divide it by the cost index, and that gives us the amount or the value or the value of our inventory at base year costs. So now everything is in terms of base year costs. Every single one of these years, base year costs, which means now they are directly comparable to each other in terms of volume. And that was the whole goal. Now we know, did we add a layer or did we not? And step two is going to quantify that. But that's what the first step is. We're trying to figure out, did we add a layer? And you can see that in 2024, we added a layer because it's more than 120,000. In 2025, we added a layer because we increased from 122 to 125. Then we added another layer in 2026. And you can see in 2027, we did not add a layer. In fact, in terms of volume, our volume went down slightly. We're going to talk about how we handle that. But initially, right away, you can see added a layer, added a layer, added a layer. Oops, did not add a layer. I'm going to pause there just for a second in case somebody has a question. We doing okay? All right. That is step one. That is step one. Step two then is sort of like the math that maybe you intuitively already kind of saw. And that is, okay, let's quantify and in base year costs, let's quantify how much we added. How much did we add for every single one of those layers? Now, what I'm going to do, just because I think it's an important thought exercise, is while we're going to figure out what that layer is, we're also going to sort of say, okay, how do we get from basically this change, this 120,000 to 132, how do we sort of understand, okay, what drove that change? Was it volume or was it inflation or was it cost? What drove that change? And so we're going to do like a little extra exercise, not really testable, but just to sort of close the loop on how did we go from 120 to 132, just to sort of allow you to see how it all fits together. Because I do think it helps you better understand dollar value LIFO when you can understand what changes in inventory are being driven by volume and what changes in inventory are being driven by cost. And so I do think it's important to understand that concept. And so the first thing, again, we're figuring out changes in volume versus changes in cost, or changes in quantity and changes in cost. What we've done here is we're trying to recalibrate everything, get everything in base year, which allows us to isolate quantity, and then we can kind of infer costs. Again, you're going to kind of see this as we work our way through. Was a layer added? What's the value of that layer? And then we'll kind of quantify the total change that we observe. Let's start in 2024. So when we look at 2024, the first thing we need to ask ourselves is, was there a layer added? So we know that our beginning layer was $120,000. Again, everything's in base year cost, so we can make a apples to apples comparison. And we know that there was an increase in quantity because there is a new layer. The base year cost of our ending inventory is $122,222, which is more than the original base year cost, which means in terms of base year costs, we added a layer in the amount of $2,222. But we're going to be very, very clear. That is in base year costs. We're simply saying we know that we added a layer. This isn't the amount we're going to report quite yet, but we know we added a layer and we can quantify that using base year costs. That is the number that we actually need, the increase in that layer. That's the information that we need. Now, I just want to close the loop though and say, well, how did we go from 120 to 132? We know of that change, $2,222 is attributable to an increase in quantity. Now, the only other thing that could increase or could explain the difference now is an increase in cost. Let's kind of see how that works. So the increase in cost, we can see that there was 8% inflation compared to the base year. If we apply that inflation to the entirety of our inventory in base year costs, we know that there was an increase in cost of $9,778. That's the increase in cost. So now there's two things that are driving our increase in inventory value. One is increase in quantity, and the other is increase in cost. And so if we kind of put everything together, we have our beginning inventory plus the increase in quantity plus the increase in cost for a total of $132,000, which is exactly what we see. We see the total value of our inventory on December 31st, 2024. Again, I want to be very, very clear. We are not reporting this $132,000 on our balance sheet because remember, we report things at the acquisition cost, not the year-end cost. We're also not reporting this increase in quantity at $2,222 because that is a base year cost, and we want the acquisition costs. So again, we're not done yet. This is just the next step to getting to our answer. But I want to stop there for 1 second. Does everyone understand? All we're doing here is showing you how do we go from 120 to 132? And it's a function of both quantity and cost. Okay. So then what we're really taking away then from step two is two things, is not two things, but two layers. There's the original layer, the base year layer at 120,000, and now a new layer in base year costs of 2,224. Again, this is telling us the increase in quantity at base year costs. So step two, this is really what we are after. What are the two layers that we have at the end of that year? All right, so I want you to try to do 2025. And all I want you to do for 2025 is to figure out what is the amount of the increase in quantity. What's the increase in quantity amount? Our beginning layer is $122,222. That's the beginning layer in base year cost. So I'm going to give you like a minute or maybe 2 minutes to calculate the increase that we can attribute to quantity. And again, this is going to be stated in base year cost. What is there a new layer? If there is a new layer, what is that layer in terms of quantity in base year costs? All right, I'm going to give you a minute. About 30 more seconds or so. All right, let's see how we did. Let's see how we did. So the increase in quantity, again, we find that base year amount, the newly calculated 2025 value in base year dollars of 125,446. We subtract the pre-existing layers that tells us that the new increase in quantity is $3,224. Again, that is in base year cost. This is the number that we really want, this increase in quantity. That is what we want from step two. But again, I'm just going to now show you reconciling how did we go, or how do we get $140,500? How do we get this increase that we observe? We know some of it is attributable to another increase in quantity. So how do we demonstrate that the rest of it is an increase in cost? Well, the way we do it is we take, again, this is our 2025 ending inventory in base year costs, and this is the amount of cost inflation we experience compared to the base year. And so the total increase in cost over the 2-year period is $15,054. And so if we take that information, we can see that our beginning inventory is 122,000. The increase in quantity is 3,224. So this is basically driven by quantity. Now this is what's driven by cost, the increase of $15,054. That is where we get the new balance of $140,500. Again, increase in quantity, increase in cost. Again, we don't need that information. We're just showing you how do we see this change in our inventory. There are two things that always drive it: increase in quantity and increase in cost.
So when we do this on the exam, we're mainly just worrying about the layers and the increase in quantity.
Exactly. This is the
Okay.
number that you're after on the exam. This is just more to show you the full picture. But this is the number you want to get to, 3,224. So really this next slide is what you're after, is that there are now 3 layers. There's the base layer, there's the 2024 layer, and now there's a 2025 layer. And every single one of those layers is at base year cost. I want to be very, very clear. This is not what we would report. So we wouldn't just sum these and report that on our balance sheet. That is not what we would report, because that's not LIFO. That's base year cost. That's not LIFO. LIFO would be at the acquisition cost. And that's what we need to include in these layers. So we're not there yet. That'll be step 3. But with this step 2 is important. We've got to isolate each layer in terms of quantity. All right, 2026. I'm going to go a little bit faster through this one since we've seen a similar example. Again, our beginning layer is what we had at the end of 2025, 125,446. When we did our calculation, we had a new base year amount of $133,333, which of course shows that there was an increase in quantity of 7,887. This is the number that we are after in step 2. So we had an increase in quantity in base year costs of $7,887. So that is the change that's attributable to quantity. That is the number that we need. Now, in addition to that, of course, there was an increase in cost, and that increase was 14% over base year costs. And so the increase in cost is $18,666. So if we want to know, how do we go from 140 to 152? Well, there's several things. First of all, there was the beginning amount or beginning quantity in base year costs plus the additional layer in base year costs. That's the increase in quantity, right, at base year costs. And then the 18,666, that's the increase in cost. That's what we attribute to cost inflation. And that's where we get the 152. Again, the key here, though, is we're after the $7,887 layer stated in base year costs. So the picture we really want is that there are now 4 layers: 120,000 base year, 2,222 for 2024, 3,224 for 2025, 7,887 in 2026. Again, to be clear though, this is not what we would report on our balance sheet, because on our balance sheet under LIFO, we need the acquisition costs, and we don't have that yet. All right, so then 2027, Our beginning layer, 133,333. Now, unlike the prior years, we already mentioned, but we're just going to sort of now quantify it. You can see that instead of an increase in quantity, we had a decrease in quantity because now in base year costs, the quantity went down by $1,202 in base year costs. Now, what this means is there is no new layer in 2027, and there never will be. So 2027 will never have a layer. And instead, we're going to probably we know we're going to dip into our prior layers. We'll have assumed that we sold some of our 2026 layer, and that's all we're going to need. But conceivably, we could have even gone into our 2025, 2024, or even base year layer. But in this case, we're only dipping into the 2026 layer. But again, to reconcile everything, how do we go from 152 to 161, 200? It's both the increase in quantity, or sorry, the decrease in quantity, but there was an increase in cost. So it's weird that we went up, yet the quantity went down. It's because the price increase was enough to make up for it. So the total increase in our inventory attributable to cost is $29,069. And so we do that math, we have our quantity in base year costs at the beginning of the period minus the decrease in quantity over the period plus the increase in cost. And together that gets us our new basically end of year inventory of $161,200. Again, to be clear, this is not what we report on the balance sheet. This is just what we've tracked. This is what we know we have in terms of current costs. LIFO does not report things at current costs. It reports things at acquisition cost. And so then what we have in 2027 is we still only have 4 layers. We have our base year layer, our 2024 layer, our 2025 layer, and now a slightly lower 2026 layer. And that is really where we're trying to end in step 2. So for every single year now, we know exactly how many layers existed for that year. But again, those layers now are stated at base year costs. So the final step is to take those layers that are at base year costs and now adjust them to the acquired cost or the acquisition cost. And so every single one of those layers has to be adjusted based on the cost index. So we're kind of readjusting each layer to that to the correct acquisition cost. And so how do we end up doing that? Again, just as a reminder, step 2, everything was done that 100 and every single one of these dollars here, that's year-end cost. That's not what we report. And when we did the layers, those are at base year cost. That's also not what we report. We need to get to the acquisition cost. So in 2024, there were 2 layers, if you remember. There's the base year layer, and the cost index for the base year is 1. So that's 120,000, no adjustment to that. We added a layer at base year costs of $2,222. The index for that layer is 1.08. So now our new layer at the acquisition cost is $2,400. And so when we report our ending inventory under dollar value LIFO, we would take the base year costs and the 2024 layer costs, or sorry, the acquisition costs, and we add them together. This is what we would report. We would report $122,400 as our ending inventory under dollar value LIFO. We would then use that amount to back into cost of goods sold. And so sort of like a periodic approach here. So we would back into our cost of goods sold using that information. Does everyone understand? We got 2 layers, right? One layer at the cost index of 1, one layer at a cost of index of 1.08. Of course, the new layer is very small compared to the very large layer that may have been building for a long time. Is everyone okay with that? All right. So I want you to do the 2025 calculation. What will we report under dollar value LIFO in 2025? knowing that there are three layers. Again, I'm going to give you a minute to see if you can calculate that one on your own. All right, let's see how we did. So we still have that base year layer. We still have the 2024 layer. Those things didn't change. And now we're adding our 2025 layer. Again, the at base year cost, the 2025 layer was $3,224. The cost index is 1.12. And so under dollar value LIFO, this is how much we would value the 2025 layer of $3,611. So now we have three layers, all at their acquisition costs. And so we add them all up, and we would report $126,011 under dollar value LIFO. This is our ending inventory amount. We would use that to infer our cost of goods sold. So then in 2026, we still have those same three layers. That didn't change because remember, we added a layer in 2026. And again, that layer in base year cost is 7,887, of course, but we need to report it at the acquisition cost, which means we need to adjust it for the cost index. And so the acquisition cost of that layer is $8,991. And we add them up, we would report $135,002 under dollar value LIFO. And again, we're not tracking units, we're not tracking unit costs, we're using cost indices. And what we observe is the total value of our inventory. We're using it to infer or estimate what we would report under dollar value LIFO. Again, we are not tracking this specifically. This is an estimate. And then finally for 2027, we still have those same three layers, the base year, 2024 and 2025. And then remember, our 2026 layer got a little bit smaller. In base year cost, that layer is at $6,685. We again adjust it for the cost index. This is the acquisition cost of those remaining items in the 2026 layer. We add those up. We would report $133,632 as our ending inventory under dollar value LIFO. And so on the test, hopefully you could imagine step one, get everything in base year costs. Step two, calculate the layers for every single year. Step three, adjust it to the dollar value LIFO acquisition cost and report that ending inventory for every single year. So there's a three-step process that you're gonna have to do on the test, just like we did here. And you'll have to show each step, just to be very, very clear. It's going to be written in a way where you got to show me every single layer, and it's all going to be points. So the nice thing is it does give you partial credit. If you make a mistake early on, I'll be able to see your work, and as long as you show your work from there, you'll get partial credit.
I have a question.
Yeah.
So for on the test for step two, will we have to show the increase in cost and the ending inventory at year-end cost?
No, you'd only have to show the increase in quantity for that layer.
Okay, thank you.
Mhm.
So basically, following up on kind of what she said, so the increase in cost, when we do that, that's just kind of a way to double check our work.
Yes, it's just demonstrating to you like where did the increase in the value of my inventory come from? Because it has to either be increase in quantity or increase in cost. And we were just sort of showing you where those two things came from.
Okay, thank you.
Mhm. Any other questions? All right. Advantages of dollar value LIFO. First of all, we didn't need unit information, right? I mean, that's kind of the big thing is we don't have to track units and we don't have to track unit costs. If you have complex manufacturing process, hopefully you could see where that'd be really difficult. I mean, if you're getting shipment after shipment after shipment in day after day after day, it might be very difficult to track every single unit cost. And so by simplifying things, you're just reducing the cost of tracking your information. And so that's a huge advantage. Maybe smaller so, but still true, is that because of the way you're building out your layers, it's less likely that you're gonna have a large LIFO liquidation, because it's the way you're pooling things. You have quantities that kind of, if I have several different items all together, I could have a liquidation of one particular item, but if it's sort of consumed by all these other things, it kind of gets lost in the noise. And so you're less likely to have a very large change in your gross margins attributable to some sort of liquidation. Just again, it's a manufacturing sort of process. So we're at 1242. I really wanted to get a little further into chapter 9. But obviously I don't want to, we're kind of out of time here. So what I'm going to do is, over Thursday and that following Tuesday, we're going to cover, I'd say, like the main things. And then, some of the more small things, I'll probably just refer you to the YouTube lecture or something like that. But there's really kind of three main things that we've got to make sure we get done. One is lower of cost or net realizable value, lower of cost or market, and then the retail method. And so those are kind of the three main things that we need to cover. And so that's where we'll be spending the majority of our time. So I would expect we'll get lower cost or net realizable value and lower cost or market done on Thursday. So anticipate that, prepare for that lecture. And then the following Tuesday, we will spend most of our time using the retail method. And so hopefully all that makes sense. But thank you for tuning in. I'm going to stop the recording here.